Thanks, Ildana, for the intro. Hello and welcome, everyone. In this next conversation, we're going to be discussing the regulatory outlook for Bitcoin and crypto assets in the United States. We have a great panel today. Joining us are Lewis Cohen, co-founder of DLx Law, Colleen Sullivan, co-founder and CEO of CMT Digital, and Peter Van Valkenburgh, research director, Coin Center. So we find ourselves in a kind of an interesting point in time to be having this conversation. We're coming off 4 years of the Trump administration's relatively laissez-faire approach to not just Bitcoin regulation, but sort of financial regulation more broadly. We have a unified democratic government, and we're poised to see a lot of change in the United States. So to kind of get the audience's feel on that, we polled a Twitter audience to ask them a couple questions about Bitcoin regulation. So our first question is, what's the best way to regulate the crypto industry? We gave the audience a couple options: a bank license, a money transfer license, self-regulation. None of it appealed to them. Far and away, with 55% of the vote, is no regulation needed. We think that highlights a little bit of cognitive dissonance in this space, because our second question asks, what is the biggest obstacle to widespread institutional adoption of cryptocurrencies? And the top answer there is that the regulatory framework is not working. So whether you think the regulatory framework is already too burdensome, or if you think it needs to be abolished entirely, probably up to the perspective of who you ask. But luckily, we have 3 experts to give us their opinions today. So I'd like to go first to Colleen, who's our panelist perhaps with the most day-to-day interaction with crypto asset trading, and just ask her simply, Colleen, do you think the regulatory framework is working?
Yeah, it's a good question. If I had a magic wand, what I would do is, I would start with self-regulation probably 8 years ago, and then there would be some federal legislation specific to the crypto industry. It's a brand new asset class that should not have, 20th century rules applied to 21st century technologies. But of course, that's not where we are. I think the answer is complicated. And I thought maybe I could highlight some of the things that the regulators are trying to grapple with in that context. So the first is the crypto genie's out of the bottle. You can't put it back in. So this is a global phenomenon, and there's obviously no Bitcoin or Ethereum CEO to call if there's a problem. It's just software running on the internet. So, if you think about regulators or policymakers trying to use U.S. entities effectively as choke points, the activity is not going to stop. It will just move peer to peer. And I think of it like this. If you think about Tesla, a U.S. company trading on U.S. markets, it's really a U.S.-centric thing. And it's really hard for non-institutional players outside of the United States to access it. Cryptocurrencies, of course, are the exact opposite. Take Bitcoin, for example. It's fungible all over the world, accessible by everyone. So there's only so much any one regulator in any one jurisdiction can do. Ripple is a good example of this. As people know, the SEC filed a complaint over the holidays, and it caused a number of exchanges in the United States to delist Ripple, even prior to Ripple responding to the SEC. But you know what? Ripple's up 84% over the last 12 months. So what does that tell us? It tells us that XRP, while it has suffered some damage in the United States, it's far from dead due to the global nature of the asset and its global accessibility. If this type of action had happened against a U.S. publicly traded company, the United States is the only geography that really matters. But here, it's just one of many, many different geographies. So it's complicated.
So you bring up a great point, which is that crypto assets, they are different from traditional financial assets. They're based on a new technology. For the last, call it decade, we've been trying to sort of fit a square peg into a round hole, and to kind of have existing financial regulators take the lead in whatever sort of piece of the crypto industry fits into their wheelhouse. And that, has had its shortcomings, right? So we kind of have the potential for new legislation. We have a unified government. Democrats are in control. There's sort of a potential for new ideas to kind of come to fruition here. So maybe I'll ask Lewis. Lewis, what do you think the prospects are for new legislation, and what do you think might be the contents of some of that coming in the next couple of months or years?
Well, thank you. I mean, certainly trying to prognosticate about what's going to happen in the new Congress in any area is very difficult. We have a near deadlock in the Senate and very so there are a lot of questions across the board in terms of legislation. There are also many legislative agendas that the Democratic side of the House and Senate are pushing forward that don't relate at all to digital assets. And so I think there are certainly some reasons to be cautious about hoping for legislative solutions, in the current Congress. That being said, on the positive side, much of the potential legislation here should be relatively nonpartisan. What we'd like to see, as Colleen, if there is legislation, it's a legislation that helps make America this critical emerging technology and allows, reasonable business to go forward without, unduly jeopardizing, consumers, investors, or others. And that should be something that both the party and the Republicans can get behind. So I'd be cautiously optimistic that perhaps in the latter part of this year we could see some movement after other legislative agendas come together. There are a couple of pieces of legislation I'm particularly excited about. One, Peter Van Valkenburgh was intimately involved with, which is the Digital Commodity Exchange Act. Another, I was. Securities Clarity Act. We can talk about those, but I think if those were passed, we'd move things forward in an important way.
Yes, I think that myself and others agree that the prospects of legislation in the near term are pretty slim. Congress typically has bigger priorities, especially now amid the pandemic and the economic downturn, right? So it seems like the near-term outlook is mostly going to lie with the regulators. And I know there was a relatively consequential rulemaking put forth at the end of the Trump administration from FinCEN. Maybe I ask Peter's opinion on that regulation sort of fell short. There's a delay. It might be rethought under a Democratic Treasury. So Peter, tell us how you think that might change from the Republican proposal to a Democrat sort of final rule.
Yeah. So, it's important to point out that in America, we don't regulate technologies, we regulate activities. So we don't have like omnibus internet regulations, and that's by and large a good thing. But if people decide to do a certain regulated activity using the internet, we have regulations that apply. The same should be true of cryptocurrencies. We're not going to regulate a whole technology like Bitcoin. That's nonsense in the American system. But we might regulate some activities that people do using the Bitcoin network, activity-based regulation. Now, the regulation that you're talking about is anti-money laundering regulation. Nothing to do with investor protection, like what the SEC deals with, or consumer protection, which is what state money transmission licensing deals with. Anti-money laundering regulation is done by FinCEN, a subdivision of Treasury. And it's true that at the end of the Trump administration, we had a new rule proposed by FinCEN that concerned how exchanges need to collect information about their customers, AML KYC rules. So the first thing I want to point out to an audience that might be unfamiliar with this stuff is that Bitcoin has been regulated. Activities that people perform using Bitcoin have been regulated for anti-money laundering purposes since 2013. If you're holding other people's Bitcoin for them and sending it on their behalf, you need to register with FinCEN, know your customers, perform suspicious activity reporting requirements, and other record-keeping duties. Now, what the Trump administration tried to do at the very end of their term in a sort of midnight rushed rulemaking was say that these exchanges that hold people's Bitcoin for them, they don't only need to know their customers, they also need to know the name and physical address of the people their customers are paying on the peer-to-peer Bitcoin network. And that is, in CoinCenter's opinion, and I think now widely regarded, a step too far. This is all warrantless mass surveillance, and it's acceptable. We've accepted the fact that banks are going to spy on their own customers. But the notion that we'd have banks and other financial institutions not just spying on their own customers, but spying on their customers' counterparties is really just, it's not tolerable in a constitutional system where in theory we should have a warrant requirement for a search or surveillance action by the government. And fortunately, the rulemaking got slowed down at the end of December, at the end of the Trump administration, got pushed into the Biden administration. and then got extended for a full 60-day comment period. The original comment period wasn't even 15 days. It was a radically short comment period from an administrative law procedure. So it was really being rammed through. Now it's slowed down, and now we're actually quite optimistic that all we'll get from FinCEN as far as new rules for crypto is that if you're an exchange and your customer withdraws $10,000 or more, just like a bank might have a customer withdraw $10,000 in cash or more, it'll trigger a currency transaction report. It'll just say, my customer took this much money out and is moving it around on the peer-to-peer protocol. It won't require the bank or the financial institution to identify the names and physical address of the people, or frankly, smart contracts and robots that their customers might be paying. It's something that will still allow law enforcement to get the information it needs to police crime on these networks, but won't destroy the viability of the technology or be a huge overreach into our personal privacy.
Yeah, great. So that seems like a moderating effect, right, as the Democrats sort of take over from the Republicans, although by and large, Republicans didn't do a whole lot in the past 4 years on crypto asset regulation. But sort of on the other side of the coin is that the Biden administration is expected to nominate Gary Gensler to lead the SEC. He has a really strict enforcement record as at the CFTC, where he oversaw the implementation of the Dodd-Frank Act's really significant overhaul of the swaps market after the financial crisis. So I guess I'd go back to Colleen here and say, how are you preparing for a Gensler SEC, and what are you worried about?
Yeah, well, similar to what Lewis said, I'm cautiously optimistic. The upside with Gensler is that he is substantively very familiar with the crypto space. He taught a course on crypto at MIT. He really understands. I think on the institutional side and obviously the retail side, I do expect we'll see a Bitcoin ETF, and I think that will be welcomed by the industry. I think that one of the challenging aspects is going to be, Gensler is a progressive guy, right? And so you think about, what is crypto all about, right? We're building a parallel financial system next to the existing traditional financial system. And the hope is that, like Bitcoin, it'll be open to everyone, owned by no one. And we've got this wealth gap in the United States that is increasing rapidly. And there's a lot of frustration from people, rightfully, who want better access to the financial system. Who want better access to the financial system. We saw this very clearly with GameStop. And so democratization of this type of financial access, what crypto provides, assuming proper guardrails are in place, is really something that a Democratic administration, Gensler, you would expect them to embrace. And I think it's important to keep in mind that the crypto industry started from the bottom up. This started with retail investors first, not the other way around. And so in many respects, notwithstanding the rapid, institutional involvement we're now seeing, it's really the people's financial system that we're trying to build. And so I think it's going to be tricky to look over at the space and say, well, everything's a security and maybe only accredited investors should participate when non-accredited investors built the system. So I think there's going to be this tension between, for example, not taking a sledgehammer to decentralized finance and instead working with industry, engaging with industry, sharing what are the risks that the SEC is concerned about. And then it's incumbent on industry to figure out how to build the tools to help mitigate those risks. I also think it would be absolutely fantastic if we see Gensler and Commissioner Peirce collaborate, and if we got some movement on Commissioner Peirce's proposed safe harbor. That could be naive thinking, but I'm a glass half full kind of person. So again, cautiously optimistic.
Yeah, I love your point about access, retail access, right? This is by and large a retail-driven phenomenon. I think most people out there watching are probably thinking that approval of a Bitcoin ETF is a potential catalyst for the asset class going forward. I know that in the past, some of the reluctance to approve an ETF has been, it's been kind of opaque. It's hard for retail investors to follow this and kind of understand what is the obstacle. Some of it had to do with poor surveillance over the spot markets, or concerns that retail investors might, lose their money if they invest in this asset class. So maybe I'll go to Lewis and say, what would be some of the signs that a Bitcoin ETF is making some progress, and what do you think a Gensler SEC is going to think about some of those applications?
Yeah, so a new ETF application was recently filed, and I guess, in terms of signs for progress, we have to see how that progresses. One very positive sign is that Canada recently approved one Bitcoin ETF, and I understand is shortly expected to approve a second Canadian ETF. Canada has been a little bit of a proving ground for the exchange-traded fund sector, and in the past has kind of led the way, and the SEC has kind of taken into account. It doesn't drive SEC decisions, of course, but it is duly noted when a similar jurisdiction has made a move in that direction with similar investor protection concerns. I think it will be a bit of an uphill battle to get an ETF approved here in the States. I think, as you noted, one of the concerns is what's loosely referred to as market manipulation, and particularly vocal about the kind of uneven way in which the Commission has applied concerns around the depth of markets and the ability to manipulate markets. And although they have, the SEC has said no to other ETFs where there were similar concerns. They've also to ETFs that have probably much shallower markets and easier to manipulate markets than Bitcoin itself. I think one of the underlying, although not clearly articulated, is if a Bitcoin ETF is allowed to go forward, and if, despite everyone's hopes and expectations, we see a severe drop in the price of Bitcoin because of exogenous events, there may be a concern that the government is in a position of being a buyer of last resort. And for all of us who lived through the great financial crisis of 2008, 9, 10, we saw that the government was obliged to step in and be a buyer of last resort of a wide variety of assets. And I think there is a real reluctance to put in place, the type of financial instrument that would effectively make, the Fed or another, the Treasury or another governmental entity, the buyer of Bitcoin at that degree. And so I think there are some definite, questions around that.
Yeah, it's a great point. So speaking of this sort of like retail institutional tension, I want to go to Peter for a second here. Just kind of broadly speaking, conceptually, is it better for regulators to prioritize institutional adoption of the asset class, or is this like a whole new sort of financial system where they should really prioritize retail access? And how do you think kind of one or the other approach might affect the asset class in the long term?
I mean, so Coin Center is a nonprofit based in Washington, D.C., and we're focused narrowly on defending people's freedom to innovate using the underlying technology. And so to some extent, that's more of a retail than institutional concern, although the presence of institutional parties is certainly good for the ecosystem. It brings a sort of gravitas, and it brings a lot of capital into the system that can be used to build better technology. So I'm not sure I have an opinion about that, although just in general, I don't think the job of regulators is to sort of prioritize one investor over another. That's exactly the opposite of what we would want regulators to do. I think we just want even and steady rules of the road, the rule of law, reasonably clear expectations of when you're going to be regulated and when you're not going to be regulated. Because when you're in that gray area, you run the risk of doing something that you thought was sort of free and open for you to do, but actually suddenly you've transgressed the law and you might end up with strict penalties. To that end, state money transmission licensing rules are still actually kind of a mess in this country. Every state has a different definition of money transmission. Some of them include certain Bitcoin-related or crypto-related activities within that definition. Even if you're pretty sure you are a money transmitter because you're a company like Coinbase, you've got to go through this ridiculous process of getting licensed in 53 states and territories in order to do an activity that is digital and global by default. So I think we could have much more reasonable regulation, not from a privileging retail investors versus institutional investors standpoint, just from a rationalizing regulation so that it's applying at the scale that makes sense. And the scale that makes sense for things like consumer protection is a federal regulation, not a state-by-state regulation. So as Lewis said, one piece of legislation that we are kind of excited about, although I do think it's hard to get anything through Congress because this is probably not a priority, But a piece of legislation we are excited about is the Digital Currency Exchange Act, which would create an optional spot market license category for exchanges to get regulated by the CFTC instead of having to get all the money transmission licenses. So this would be easier for the businesses that are helping people buy and hold Bitcoin, and that's good for those businesses and good for their retail customers to the extent that they're acting as a proxy for their interests. But this is actually also good for consumer protection, because we would get a global view of how these companies are operating rather than just a view of what they're doing with their customers in Idaho, which makes much more sense for a global technology. Additionally, we'd get some spot market supervision and market surveillance, which is the exact thing we need, from a regulator like the CFTC that's used to that kind of market surveillance in the derivatives context. And it's the exact thing we need in order to have more comfort with respect to manipulation of the price and things like that, which might ultimately lead the SEC to do something like approve an ETF because they feel like there's now better market surveillance. So I think that is a win-win for everyone. Again, Congress is another question.
Yeah, I definitely think consumer protection will drive a lot of what the Gensler SEC does, and so in the previous administration, that consumer protection angle was, at least in my opinion, focused a lot on some of these ICOs and other sort of offerings that were deemed securities as kind of a way of protecting investors, including XRP. And I know everyone on the panel has a lot of opinions about whether or not crypto assets should be securities. So maybe just quickly, Lewis, tell us whether you think that XRP ruling might change under a Gensler SEC, and then what that kind of means for stable coins and other products like that moving forward.
Gosh, that's not a quick one. I'll try and go as simply as I can. I think the point Peter made is one, that we have this lacuna in our regulation around digital assets. Things like Bitcoin are readily acknowledged not to be securities. There's no, as Colleen said, there's no CEO of Bitcoin. But with other assets like XRP, it's more complicated. The XRP is simply, what is a digital asset? It's a string of code. In and of itself, it is unequivocally not a security. However, because of the way digital assets like XRP are sold, even after they're resold and resold and resold in markets, there is a clear correlation of the value of the asset with its progenitor, sponsor company, in this case, Ripple Labs. And that's tradable by retail people and has an important externality, which is its potential dependence on, or at least involvement of, some company. Again, in the case of Ripple Labs, that would be XRP in the case of the Ripple Labs case. I don't anticipate the Gensler-run SEC taking a different position than the Clayton-run SEC did. I think the enforcement staff of the SEC.
All right, looks like we're having a little trouble with Lewis there. Maybe let's put this all into perspective here. Sort of, what does this mean for U.S. competitiveness going forward? Colleen, I know that you trade a lot in these markets. Where do you see liquidity right now? Is it in the U.S.? Is it offshore? And does it, establishing a better regulatory framework bring some of that to the United States or other sort of more regulated jurisdictions?
Yeah, so I think right now we're sitting somewhere in the middle between, regulated exchanges and unregulated exchanges and where that liquidity lies. I will say, it's challenging for trading and investments firms that are based solely in the United States without, offshore offices. So for example, while CMT is headquartered in Chicago, we also have offices in London and Frankfurt. And, having those offshore offices is helpful to us, and I'll explain why. So if you're solely based in the United States, especially post-BitMEX, it is very difficult to access liquidity on non-U.S. exchanges. Post-BitMEX, many of these exchanges really tightened their KYC, AML policies and procedures. And if you have traders physically sitting in the United States, you pretty much can't trade on those exchanges. And to your point, that's where most of the liquidity is still right now. The same holds true from an investment standpoint, especially if you're looking to invest in tokens. Most deals exclude U.S. investors from participating. So this regulatory kind of unclarity that we have right now is challenging for firms building businesses in the United States if this is the only jurisdiction that you reside in. I wanted to just quickly pick up on something that Peter said, because I think it's really important. Peter mentioned that FinCEN started regulating the space in 2013. And at that time, really the only asset that FinCEN was looking at was Bitcoin. We now have over 6,000 different cryptocurrencies. To Peter's subsequent point, with this new legislation and having the CFTC step in and take a look at oversee the spot market, many of these crypto assets really will be utility. If you think about where this is going, you will have tokens powering creator, social, gaming economies. Those are, in our view, commodities. We're all commodities. The only things that aren't commodities are movie receipts and onions. So, that seems to be a very good solution to some of the ambiguity that we're dealing with today.
Yeah, and so you bring up a great point, which is that we need to be open to the potential for technological innovation here, as sort of an asset class, but also as potential infrastructure for sort of a future sort of new financial system, right? So I have a question for all of you, but maybe we'll start with Peter. Is do you think that the Biden administration and some of the regulators that he may appoint, are they open to the idea that this comes down to U.S.-China competitiveness or U.S.-Russia competitiveness, and that the U.S. needs to lead here on crypto assets and the related technologies? And if you think that's true, then what are some of the ways that the U.S. government can be pro-competitive there?
I think there is an international competitiveness issue. When we look at the emergence of China's sort of central bank digital currency, when we look at the current rise of Bitcoin, I think the writing is now on the wall that money and maybe a lot of other things are going fully digital and peer-to-peer. And then the question is, how do we want to architect these systems that move these peer-to-peer digital assets around? Do we want to build them such that they have inherent central control from a government and like oppressive surveillance from a government, which is quite frankly what China's building? Do we want to risk foregoing our sort of basic human rights and human dignity to the extent that we hand all of our intimate transaction details to a central authority? I think the answer is no. That would be a very un-American way to build these systems. And the alternative is Bitcoin. The alternative is this peer-to-peer network that empowers the individual, protects the privacy of the individual, and honors that individual's autonomy. It says that if I want to send a Bitcoin to Lewis, I can do it directly, and I don't have to trust a corporation or a government in the middle. That's the spirit of the American West. It's the spirit of the immigrant cities. It's the spirit of what makes America a great country. And so I think, like the Clinton administration with the internet in the 1990s, we can capitalize as a nation on having a pro-innovation policy towards these new global information superhighways. The information is not just communications anymore. It's financial data. It's actual money moving around. And I think we want an open, permissionless system for that, even if it means that some people will use those systems for crime. If you believe humans are genuinely good and in general good, a little bit of crime is tolerable because most people are going to be using those permissionless networks to do the right things to move our species forward.
All right, so Peter is staunchly pro-privacy, pro-independence. Colleen, what do you think about how, will regulators think a little bit of crime is acceptable? Is a regulated sort of entity more likely to succeed here? What are your thoughts on that?
Well, it's hard to follow Peter on that. I think you just close with Peter. No, I think, one of the beautiful things about this technology is that it's friendly to law enforcement and regulators, right? So there's this ability to, Bitcoin is not fully anonymous, so there's an ability to track for nefarious activity. And the blockchain analytics are getting so good that today there's almost a 2.0 of those analytics where they're able to predict. So the regulators have this public, transparent, blockchains at their disposal to help them regulate the space, which is obviously something that does not exist with cash.
Yeah, that's great. So maybe I'll let Lewis have kind of the final word here, finish his thought on securities or a final thought on privacy and decentralization.
I'll pick up, thank you, and sorry I got cut off before. Yeah, I'll pick up on this last point because I think, again, Peter and Colleen have made some great points. The one thing I would add is that if this were just about Bitcoin, it would be relatively simple. And I think, Peter, you articulated the case for Bitcoin very well. The reality is we're moving to a world where value is inherently fluid, and value goes far beyond Bitcoin. In the past, we had a clear distinction between things that were money and everything else that you bought with your money, that you invested in, that you did things. Now it's not so clear. The example I like to use are ramen noodles, which normally we boil and eat as a soup. How noodles are a common currency. What we're seeing with digital assets is more and more blurring of what is a digital asset and what is its purpose. Ether is used to run smart contracts on the Ethereum network, but at the same time, it's also used as a currency. Regulators are going to have to continue to grapple with that fluidity and what that means for the wider financial system.